Out first. Okay, participants are joining. Good afternoon, everyone. Good afternoon, good morning, good evening. We'll wait for a few minutes before we start the webinar. We'll allow some more time, another couple of minutes, then we start. Thank you. Shall we start then?
Yes, I think we can start.
Okay. Distinguished panelists, esteemed guests, ladies and gentlemen, it's my honor and privilege to welcome you all to this webinar on application of Islamic finance in infrastructure PPP projects. I will be moderating the session today, where we will explore a topic of immense importance and potential in the field of infrastructure development, particularly within the context of Islamic finance and public-private partnerships. A brief introduction about myself. I'm currently working with one of the largest Islamic banks in Saudi Arabia in the project and structured finance division. Prior to that, I was with the National Center for Privatization and PPP at Saudi Arabia, and before that, in different Islamic banks within the region. Before moving to the region, I was in India working at the Infrastructure Development Finance Company, where I picked up the PPP skills. So I have about 25 years of experience in structuring and advising and financing PPP projects. I would also like to introduce two distinguished panelists here. We have Mohammad Hamra Kroa. He heads the Clifford Chance Banking and Projects team in Abu Dhabi and leads Clifford Chance practice in Abu Dhabi and Saudi Arabia. He has an excess of 20 years of experience advising governments, sponsors, and lenders on PPP, energy, and infrastructure projects. Mohammed joined Clifford Chance in 2001 in Paris and has been working on projects across the Middle East since 2005. Mohammed is advising sponsors on multiple PPPs in Saudi Arabia, Egypt, and across the Middle East region. A partner since 2008, Mohammed specializes in banking and project finance, both conventional and Islamic, in the Middle East and North Africa. Some of the relevant projects, PPP projects he has been working includes the recently closed Al Ansar Hospital PPP project in Saudi Arabia, the 50 megawatt solar IPP in Egypt, 250 megawatts Gulf of Suez wind IPP, Huije wind IPP in Jordan, and he has advised the General Authority of Civil Aviation in Saudi Arabia and several of the new projects which are to be privatized. He also worked on Al Zur North and Al Zur North 2 IWPP projects in Kuwait, and also worked with the Water and Electricity Company in Saudi Arabia in relation to Raza Zur, Sukhair, and Shuaiba IWPP projects. I also have the pleasure to introduce another distinguished panelist, Afzal Sidat. Afzal Sidat is currently executive manager at Bubian Bank in Kuwait. Afzal joined Bubian Bank in 2050 and has over 18 years of corporate and investment banking experience. He is currently the unit head structured finance and syndication unit at Bubian Bank. Prior to joining Bubian Bank, Afzal was an area manager at Al Raji Bank in Riyadh, where he gained valuable exposure to, amongst other things, project finance and Islamic structuring. Afzal holds a bachelor degree in economics and econometry from University of Johannesburg, South Africa. He had worked on Tawila IWPP in Abu Dhabi, Hasian IWPP in Dubai, and J3 Social Housing Kuwait, to name a few. Infrastructure development is a cornerstone of economic growth and societal progress. It encompasses vital sectors such as transportation, energy, water, and sanitation, which are essential for improving the quality of life and driving sustainable development. However, financing these large-scale projects often presents significant challenges, especially in regions where traditional financing mechanisms are constrained. This is where the synergy between Islamic finance and PPP comes into play. Islamic finance, with its principles rooted in Sharia law, offers ethical and socially responsible financing solutions. These principles align seamlessly with the objectives of PPPs, which aim to leverage private sector efficiencies and innovation to deliver public goods and services. Over the past decades, we have witnessed substantial growth in the adoption of Islamic finance for infrastructure projects, particularly in the MENA region. Islamic financing has been instrumental in raising funds for projects ranging from highways and bridges to energy plants, schools, and hospitals. Countries like Saudi Arabia, UAE, Malaysia, and Indonesia have been at the forefront of this movement, demonstrating the feasibility and benefits of integrating Islamic finance into their infrastructure development strategies.
Ida, you're mute. Sorry.
Sorry. Despite these developments, there are still challenges to be addressed, ensuring Sharia compliance, managing risk, harmonizing regulatory frameworks, and increasing awareness and education about Islamic finance are critical areas that require our attention. Additionally, the integration of fintech and digital innovation holds great potential for enhancing the efficiency, transparency, and accessibility of Islamic financial products. Today, we have the privilege of hearing from this panel who will share their insights, experience, and perspectives on the application of Islamic finance in infrastructure projects. I encourage all attendees to ask the question through the Q&A chat box. Time permitting, we will try to address all the questions. Otherwise, we will endeavor to reply individually through emails. Thank you once again for joining us. I look forward to a fruitful and enlightening session. We will begin our session today with a brief presentation introducing Islamic finance and Islamic financing products deployed to finance PPP projects. Let me share my screen. Is my screen visible?
Yes, we can see.
Okay, thank you. So today's agenda, we started with the webinar introduction. Now we will have introduction to Islamic finance, which will be followed by panel discussion and Q&A from the audience. What is Islamic finance about? Islamic finance is a system of financing practices that comply with Islamic law, which is known as Sharia. It emphasizes ethical and equitable financing transactions, prohibiting interest and speculative activities. It instead promotes risk sharing and profit sharing arrangements through structures like musharaka and mudarba, which are partnership and joint venture structures. Islamic finance products also encourage transactions to be backed by tangible assets or services, which will ensure the direct link between financing activities and real economic productivity, fostering transparency, fairness, and justice. What are the key principles of Islamic finance? The first and foremost is the prohibition of riba, which is the interest. So charging or paying interest is strictly prohibited in Islam. Instead, financing transactions should be based on profit and loss sharing. The second principle is the risk sharing. All parties in Islamic financial transaction must share the risks and rewards, ensuring a fair distribution of profits and losses. The third one is prohibition of excessive uncertainty, which is known as gharar. So Islamic financing contracts and transactions must avoid any uncertainty and ambiguity. Terms and conditions must be clearly provided to all parties involved. The next principle is asset-backed financing. Islamic finance transactions must be backed by tangible assets or services, ensuring a direct link between financial activities and real economic activity. The next principle is ethical investments. Investment should be made in ethical and socially responsible activities. Financing of businesses involved in prohibited activities such as alcohol, gambling, and pork products are strictly prohibited. Then the next principle is prohibition of gambling, called maisir. Engaging in such speculative activities and gambling is prohibited. So investment should be based on real economic value and productivity. The next principle is profit and loss sharing. Financial transactions should be structured in a way that profits and losses are shared among the parties, promoting fairness and partnership. The other principle is transparency and disclosure. All financial dealings should be conducted in a transparent manner, and all relevant information should be disclosed to all the parties involved. The next principle is social and economic justice. Islamic finance aims to promote social justice, equitable distribution of wealth, and economic development. It supports initiatives that contribute to the welfare of the community. The final principle, and not least, is the compliance to Sharia law. All financial activities must comply with Islamic law, which is derived from Quran and the teachings of the Holy Prophet. A Sharia board often oversees financing institutions to ensure compliance. Let's take a few minutes to talk about the benefits of Islamic finance. As we have seen earlier, it focuses on ethical investments. It is based on risk sharing. It enables social welfare. It enables stability and resilience in the economy. It provides inclusivity for some of the population which are not accessible to conventional banks and Islamic banks. Then we talked about trust and transparency. And importantly, Islamic finance aligns well with the SDGs, promoting sustainable and inclusive economic practices that benefit the society and the environment. There is also diversification in terms of Islamic finance providing alternative financing instruments and investment opportunity, which provides diversification benefits to investors and financial markets. By prohibiting interest and emphasizing equity-based financing, Islamic finance also encourages lower levels of debt, reducing the risk of financial distress and insolvency for individuals and businesses. Islamic finance promotes real economy. It focuses on tangible assets and real economic activities, ensuring that financial transactions are directly linked to productive and value generating in the economy. Now let's look at the key products of Islamic finance. We have lot of contracts and products in Islamic finance. The key are we start with the Mudharaba, which is a profit sharing partnership where two entities come together, one providing the capital and the other providing its skills to jointly undertake an enterprise and agree to share the profits in a agreed ratio. Similarly, you have Musharaka, which is a JV partnership. where two investors come together and invest in a venture. Then third, we have Murabaha, which is cost plus financing, which is basically used as a means to generate cash. Then you have Ijara structure, which is very much like a conventional no leasing. Then you have the other structure, which is the Istisna structure, which is basically financing construction of any product. You also have a Salam structure, which is purchasing any asset or commodity in advance. And finally, we have Sukuk, which are known as Islamic bonds, but they are not Islamic bonds actually. They are based on equity principles. We'll just touch a bit on the SDGs. If you look at the 17 SDGs which we have under the UN framework, Islamic finance complies with all of these SDGs with the Islamic financing products which are available. So we start with the first SDG, which is no poverty, which is addressed by zakat, which is paid by the Muslim community, and also sadaqah, which is a voluntary a charity. We have for each of the SDGs are addressed by the different Islamic products and principles. Now we jump into the common Islamic financing structures for PPP projects. There are very commonly used structure in the region is the Istisna Ijara structure. We talked earlier about the Istisna, which is a construction financing structure, and we also talked about Ijara, which is a leasing structure. So Islamic financing involves combining one or two or more structures to enable financing to happen for any projects. Wakala structure is very similar to the external structure. We will go to this in a couple of minutes. And you also have commodity structure and sukuks, which are very commonly used for financing PPP projects. You are very familiar with the typical infrastructure PPP structure where you have SPV implementing the project, which signs a concession or offtake agreement with the government or government utilities. You have the shareholders injecting equity. You have both conventional and Islamic banks providing financing for the projects. Then you have a EPC contractor who will build the project, and you have an O&M contractor who will undertake the O&M of the project during the operations period of the project. Our focus now is on the financing, how Islamic financing is done for the PPP projects. We'll take this Istisna Ijara structure. Under this structure, the Islamic banks enter into an investment and agency agreement with the Islamic finance agent to invest in the project. This is the very first step in the project. Then the Islamic finance agent appoints the SPV, which is the project company, as its contractor to build the specified assets on its behalf. Then the third step is the SPV enters into an EPC contract with a contractor to build these specified assets. The next step is the Islamic facility agent enters into a forward lease or a specified lease agreement to lease the assets once the assets are built to the specification and delivered to it. The point to note is even though the forward lease agreement is signed upfront, but it gets activated or the lease commences once the construction is complete and the assets are delivered to the Islamic facility agent. Then the Islamic banks make their contribution to the state payments to the facility agent, who in turn makes the state payments to the SPV as its EPC, main EPC contractor. The SPV in terms makes stage payments to the actual contractor. With the stage payments, the contractor builds the assets. Upon completion of the construction, the contractor delivers the assets through the SPV and the title passes to the Islamic facility agents. So essentially, the Islamic banks hold the title for these assets and they own the assets. The next is the operation phase. In the operation phase, the Islamic financing agent appoint the special purpose vehicle as its service agent under a service agency agreement to maintain and insure these assets. So upon appointment of this agent, then the lease kicks off. The SPV mains and insures these assets on its own, or it could also do by appointing a separate O&M contractor. The SPV pays periodic lease rentals under the forward lease agreement to the Islamic facility agent, who in turn distributes these lease rentals to the Islamic banks. Upon expiry of the lease period, the title to the assets is transferred to the SPV at a nominal cost, or most of the times it is gifted to the SPV. So this is one of the common structures which is predominantly used in the Middle East region. So the points to be noted is the Islamic banks own the asset, they lease it to the project company, and the project company maintains and operates these assets and pays rentals to the Islamic banks. A similar and slightly different structure is the Wakala structure. The only difference between the Wakala structure and the Istisna structure is instead of Istisna agreement, you have a Wakala agreement under which the SPV is appointed as an agent, not as a contractor, as an agent to undertake the contract to build the assets. So otherwise, the structure is very similar and same. We have the commodity Murabaha structure. So the different participants here are the customer, the banks, and the commodity agents. As the first step is when the banks receive the customer's request, the banks buys the commodity from a commodity broker, say broker A. The bank pays purchase price and the ownership transfers to the bank upon the purchase of this commodity. The second stage is the bank sells the commodity to the customer at cost plus profit, and the ownership transfers to the customers and a debt is created in a deferred sales manner. The third step is the customer will opt not to take delivery of the commodity. In turn, it will instruct the bank as its agent to dispose the commodity for immediate settlement. So the bank, as customers' agents, sells the commodity to the broker who settles the purchase cost, and the commodity is transferred to the broker, and the cash goes to the bank, and in turn, the bank gives the cash to the customer. The seventh step is the customer makes deferred settlement to settle the debt from the murabaha, which is the cost plus. So this is not a typical project financing structure, but it is used in enabling project financing in terms of financing the equity bridge loans and cases where the istisna ijara or wakala ijara structures are not feasible. There are other innovative structures. We will not go through these structures at this point of time. There have been structures to finance assets not, which are not tangible, which have only usufruct. So these we will take it up in future sessions. So now we will go into our main agenda of today, which is the panel discussion. I will start with the first question to Mohammed. Mohammed, you have been working on PPP projects and Islamic finance in the region for over 20 years now. How do you think that Islamic finance fit into the framework of public-private partnerships?
Thank you. Indeed, I mean, we really see, as you've outlined, a very good alignment between some of the tenets of Islamic finance and PPPs. You've outlined the alignment in the purposes and objects of these. Typically, PPPs are used for the financing or the structuring and concession of social goods, transport infrastructure, or roads, or hospitals, or other social goods. And so the purposes really dovetail well with the philosophy of Islamic finance. So that's the first step. The second step is really that the term and the construction, the greenfield projects where you have this construction phase and a disbursement of the financing over a period of time, and then an amortization of the financing of the period of time really is well suited to some of the structure which you've outlined, where, for example, in the lease structure, the ijara structure, I will use alternatively the Arabic name and the English name for these. I know it can be confusing for some of our audience who are less familiar with the terminology, as well as for the istisna, so the procurement structures where really there is an asset which needs to be built and procured. And that partnership and the high leverage structure, typically which you find in PPPs, typically make the financiers significant stakeholders in the project, involved in the operation, involved in how the operation is conducted, getting information on the how the operation is happening, the progress of it, and getting involved the same way they would get involved in kind of with traditional conventional financing. But actually, it's quite suited, that involvement of the financier is quite suited to what you would expect from a stakeholder in an Islamic finance structure, where more risk is being taken by the financiers as opposed to your typical. So really, that's kind of why I see PPPs as well suited, both on their purpose as well as on their structure. And the fact is, yeah, go on.
Go ahead, Mohammed. Yeah.
And I would just say that the region has really been a good laboratory for such transactions the PPP transactions in their various incarnations, whether they are power projects, energy infrastructure projects, transport, social infrastructure such as hospitals and schools and universities, was really well suited and was a good lab for these transactions to be successfully financed across the region, but also beyond the region. Daya?
Yeah, absolutely. We started in the region, with the financing power projects. Now you have the, a new wave of PPP projects, including social infrastructure, and these projects are also very much amenable to Islamic finance. Before I jump to Afzal, there is one more question which I like to throw upon you. What do you think are the key considerations when structuring PPP projects using Islamic finance?
Ultimately, one has to consider these the same way they would consider any other project. So ultimately, it has to be a well-structured project in terms of its the commitment of equity, the choice of the various stakeholders, the quality of the contractor that's been selected for construction. So really, it's an analysis of the risks the same way you would do it in any traditional financing. I think over and above that, I would say the aspects which are unique to Islamic financing is the fact that the object, of course, has to be eligible, and most of the object of PPPs would be, eligible. I guess unless you are in a defense sector, and even there, most of the time you would be in a financing and infrastructure which is not directly involved in defense activity. But there are some sectors which are more difficult for the Sharia experts to confirm or accept, but really it's the object of the building itself. And second is really it's more suitable, I would say, to greenfield projects. It's a bit more difficult. It's of course doable in expansions, but I think it is a bit more difficult in terms of limiting the structures which are available, the flexibility which you would have when you have existing assets. You can't use the same way you could do it in a greenfield project, some of the lease and procurement and lease structures. So ideally, an object which is eligible, which doesn't infringe any of the Sharia principles which you presented earlier, and second, kind of a greenfield project with a nice longer construction and repayment period, which would be suitable for that.
Okay, what about all these Islamic structure are based on ownership? So how do you deal with this ownership aspects
Sure.
in PPP projects?
So one has to actually see that there is a bifurcation between legal title and economic title to the assets. So in looking back at some of the structures which you put in on the screen earlier, if you're looking, say, at a hospital or at an airport or a petrochemical plant, from an accounting perspective, it is very much possible that the project company, so on the equity side, would still be able to recognize the assets on their books and amortize the assets and account for it as having legal title to the asset. In most of the structures we have, we wouldn't see a transfer of the legal title to the asset to the lenders. However, through a synthetic economic interest, the lenders or the financiers to the projects would have an economic interest in the asset, either shared with the equity or in full in a specific asset. that would allow them to be able to structure the cash flow stream for them to getting repay the equivalent of a principal component and a profit component. So really, it is rarely the asset itself which rests with the lenders. The financiers and banks in particular, financing institutions, are quite loath in having in their name a big plant or a big highway. Sometimes they can't do it under regulatory reasons.
Yeah.
Some of Japanese banks, for example, for a long time struggled with the fact that they are not able to own assets other than in the context of financing. So really, the transfer of legal title is I would say never happens, but is the exception more than the rule.
Okay, thank you, Mohammed. Afzal, you have worked on several Islamic financing on PPP as well as other non-PPP projects. How do you think risks are managed differently in Islamic finance when compared to conventional financing in PPP projects?
Thank you, Hidayah, firstly for having me. Glad to be here. As Mohammed had alluded to earlier, when it comes to risk allocation and risk mitigation, Islamic bankers and Islamic practitioners follow a very similar, risk allocation strategy to our conventional peers. We obviously want a product that is bankable and investable. Where there are avenues to use Islamic finance products to de-risk, we obviously promote those. Those include items like the kaful, which is an alternative to insurance, profit rate swaps more recently, which are an alternative to interest rate swaps. And those markets are growing exponentially over the last few years. There is definitely market depth available to sponsors to help them de-risk them with appropriate Islamic structures.
Okay, great. Mohammed, one of the pillars of Islamic financing is Sharia compliance. So what does Sharia compliance means, and what are the main challenges in ensuring Sharia compliance in PPP projects? Can you just throw some light?
Sure. Obviously, structuring PPPs and financing of PPPs to ensure that they are Sharia compliant is really requires the collaboration of a number of practitioners. So you would have the PPP practitioners, be they kind of more technical or financial, the representative of the government or awarding authority, as well as the lenders, financiers, and really the compliance itself is more limited to a subset, a stakeholder, which is the Sharia scholar. And these are typically lodged within the financing institutions. So such as the institution where you're currently working, Hidayah. So these are either dedicated or shared groups of scholars that are working on a regular basis with a financial institution, that are set up by the financial institution, that actually audit also some of the financial institution dealings, and who review each of the transaction or the template documents for repeat transactions, review the structure and the documentation for the transaction which is contemplated. So ultimately, that's the ultimate gateway for the transaction before it's executed. And the whole point of ensuring a smooth process is to anticipate on these needs, where lawyers, financial advisors, sponsors, and other stakeholders basically involved early on the Sharia compliance unit or the Sharia units who work closely with the Sharia scholars in order to anticipate on these needs. There are well-established structures in the market. There is a good understanding within advisors and stakeholders of the needs and of the main tenets of a transaction and the pitfalls to avoid, to ensure that the documentation is consistent with what is expected, that it doesn't run into some of the issues that you outlined earlier, and also that you can ensure a smooth approval process at the ultimate step when the final documentation is reviewed, so that all is anticipated. I mean, I think one thing to, and we'll come to that a bit later, but I'll mention it, is that that is something which is somewhat restrictive for innovation, in the sense that it's not necessarily always ideal, because we are all working under compressed budget and compressed timelines and compressed transaction timeline to be much more creative. So the idea often is to try to see what has been tested as a structure and does it fit, and then tweak really on the margins in order to ensure that that stays within the parameters of the Sharia compliance requirements. But ultimately, that also brings down transaction costs. If you're able to leverage transaction template or a Sharia structure which has been reviewed previously, because you need not only to have complied with the requirements of one bank, but if you're doing a syndicated finance, you may have 4, 5, 10 banks with various Sharia scholars and boards that are reviewing the transaction, which you need to make sure are satisfied. So again, that often pushes transactor towards tried and tested models.
Sure, of course, all the Islamic banks have a Sharia department, having all the functionalities, which is overseen by the Sharia board. Afzal, how do you think, Islamic finance structures ensure equitable sharing of risk between public and private partners in PPP projects?
I think, Hidayah, you touched on it in your presentation earlier. I mean, there's several different type of structures available to participants, whether it be a mudaraba, musharaka, ijara, istisna, or takaful. All of these offer various permutations of combining both capital and entrepreneurial know-how to bring the most efficient value to the project. I think that these have been tested in the past, and they talk to the very core of what Islamic finance is, and that's equitable risk taking, but also equitable risk profit sharing. And I think that's what it talks to at the core.
Okay. Mohammed, in large syndication transactions, involving conventional financing, Islamic financing, ACA financing, which sit side by side in large PPP projects. So how is it structured? How do they go alongside with each other? Can you give some light on this?
Sure. So, I mean, often these co-financings, would involve side-by-side financing raised by conventional sources, export credit agencies, or conventional lenders alongside Islamic financiers. And we've worked on a number of these transactions in the Kingdom of Saudi Arabia, across the GCC, in Egypt, and elsewhere, on transactions which have these co-financing structures. And really, the idea there is that ultimately there is a fungibility of the sources of financing, and ultimately the cash flows of the concession. So I guess during the disbursement period, the cash flows from your conventional loan or your ECA loan or your Islamic ijara structure are all pooled through the disbursement process funded through the global facility agent who is aggregating these funds, and then these are dispersed to pay the EPC contract milestone during the construction of the asset or building or the PPP infrastructure. And then during the repayment period, there is, again, through the agent and through then an Islamic agent, those cash flows are captured through the agent, segregated in terms of the payment streams that are being received, calculated in order to match the profit payments that are due and payable to the Islamic financiers, and then passed on to the Islamic financiers. The one, I guess, distinction that is seen is, especially when looking at these structures in the context of difficulties affecting a project, is often the ability, the need to crystallize the claim, because often in some of those ijara structure or these structures, the financiers has a beneficial interest in the underlying assets and either leases it to the project company. That's what allows them to kind of charge a lease payment. But if there is I guess, a difficulty and the asset needs to be put back by the financiers to the project company, that's when the actual claim for the principal amount is crystallized. And then you need to rely on penalty payments, ongoing contractual obligation to pay penalty payments to keep an incentive for the project company to accelerate the payments and pay off the amounts due in principle, as opposed to being unequal in treatment because your conventional lenders would be charged. But other than that situation, I would say that we've really developed the technology, the documentation technology, to be able to have these co-financing structures, which combine various sources, pool the financing, and then have it done, have it paid through the agencies. I mean, some smaller projects that we work on regularly maybe are of a size that doesn't require those co-financing, and we see a lot of financing which are entirely financed by one or two or three Islamic financiers. So that's obviously quite customary also.
Yeah, the arrangements which you just mentioned are through a common terms agreement or an intercreditor agreement. So these agreements bind all the parties, and also you have the issue of sharing of security which is through these agreements. Okay, great. Afzal, can you share some successful examples of PPP projects which have been financed in the region, and what lessons have we learned from these projects?
Yeah, I mean, there's so many, Hidayah, many of which you've worked on
Yeah.
over the last 2 decades in the region. When I was going through the list of deal tombstones at Vubian Bank we've transacted on, the first one that came to mind was Tawila, which was a reverse osmosis plant in Abu Dhabi with the government as the off-taker. That plant, I think, provides 1/3 of Abu Dhabi's desalination water requirements. Vubian Bank, we acted as both the Islamic agent and Doc Bank on that deal. Closer to home in Kuwait, we were co-underwriters on Jabr al-Ahmed city, which is a PPP with a social residential angle. We provided 50% of the debt requirement there. The other 50% came from a conventional bank onshore. And those two examples, I think, are important to show that Islamic banks are able to fit alongside conventional peers in the debt structure and seamlessly provide funding to those projects. But also, more importantly, I think there have been projects in scale that were funded 100% by Islamic participants. Medina Airport comes to mind because of the location. The requirement was for full Islamic facilities, and local banks came up with 1.2 to $1.5 billion worth of debt for that project. In our previous life, Hidayah, remember Jabal Omar again because of the location. There was a project that attracted over $3.5 billion worth of debt, all Islamic. So there's enough, I think, track record built up over the last 2 decades in terms of Islamic structuring, documentation, ability for Islamic banks to sit alongside ECAs, conventional lenders, onshore, offshore lenders. I think the industry is starting to mature now, where the structures, documentation, and strategies that have been built up by sponsors in this region are starting to be exported to other regions globally.
Okay, absolutely right. Mohammed, I know Ijara structures and its variants have been commonly used in PPP projects in the region. In your opinion, do you think there is scope for innovation for new Islamic structures for PPP projects?
I mean, I touched a bit on that earlier when I said that there was some resistance just because of market dynamic and deal dynamic. But there is always some innovation, and there's always improvements that are arising through dialogue with Sharia scholars, structures. I would say that really, as Islamic finance spreads out from the Middle East and Malaysia, Indonesia, where historically it has really kind of had a rebirth, in the last four decades. Really, you are starting to see more friction that is happening and exposure being had to the Islamic structures, to the legal systems in other markets which are less used to that. So if you're starting to structure Islamic financing structures in certain jurisdiction in Asia or in the US or in Europe, you are going to have kind of to deal much more with the tax friction, the VAT impact when you are dealing with transfers of assets one way or another. And I think these are going to be leading to the need to be a bit more creative and into the structuring by minimizing the transfers which you may be able to do in the context of a traditional lease or procurement and lease structure, and having these done in a more synthetic way through lease or sub-usufruct structures. So really, I think it's going to be the necessity arising from the jurisdictions and the legal systems where the transactions are being organized that are going to lead the structures to be a bit more creative. Again, up to now, I think it's fair to say that no one's really wants to be creative for the sake of it. I think it's really a need that arises from being able to finance a project within its context. Sometimes it's a project which is half built, that had issues, that needs to be taken over. I think where we have seen really the border being pushed is in some of those projects that have difficulties. I'd say either projects that have had issues and need to be restructured. That's where I think we have seen sponsors and financiers and their advisors working hard to try to fit Islamic financing structures around projects which are existing without triggering some of the prohibitions of Islamic financing. So that's where, for example, we see more of the use of combining the use of traditional structures such as Mudaraba and Murabaha with, such as Ijara and Mudaraba with Ijara and Murabaha with Mudaraba. So that's actually more of a venture type investment in order to allow the financiers to get an equity kicker type of outcome if the project goes back into profit. So, I've been working on some transactions recently where we're overlaying the financing structure, which is more of a lease structure, with a Mudaraba instrument. The Mudaraba instrument there ensures that the project basically services the financing needs as much as cash flows allow, but that there is a potential for an upside to be paid should the project be more successful, more profitable towards the back end of the debt profile. So that's kind of one of the flexibilities we're trying to use.
Sure, we don't need to innovate, for the sake of innovation. There have been innovation happening, in projects where the typical structures don't fit. For example, you had the Medina Airport, which used a Mudarabah structure. And then we had the airtime facility for, the telecom operator in Saudi. These are all unique structure which can be replicated to similar structures, but, similar projects, but not, across the PPP projects. Afzal, Sukuk
Sorry,
is one
Ida.
of.
Sorry, Ida, just before we get there, I think also, just to add on to the point, while there's an important responsibility on Islamic practitioners, Islamic bankers, and lawyers in structuring around these pitfalls, I think there's also a huge responsibility on central banks and policy makers in various countries that want to attract this deep pool of liquidity. Off the top of my head, I can think about South Africa, where the central bank and Ministry of Finance amended local laws to allow for Ijara Sukuk, the inaugural Ijara Sukuk. So I think there's also an equal amount of responsibility on countries that are looking to attract Islamic finance liquidity to amend laws to allow for these structures to be implemented in their jurisdictions.
And
Absolutely.
The job there is really to put a level playing field for conventional financiers and Islamic financiers. If you're having to structure your asset through a sale and leaseback, and you have to pay a registration tax or a VAT tax when you're doing a synthetic sale and leaseback structure that needs to be registered with 5 or 10 or 20% registration fee, that's going to kill the economics. And being able to neutralize the form and as long as it's up at the substance, it's a financing structure, that's very important. A number of central banks, I think, have done that. If you mentioned South Africa, we actually worked on the South African sovereign sukuk. A number of other jurisdictions have tried to declare themselves kind of open for business for Islamic financiers by structuring that sovereign sukuk high profile. Turkey is another one. Senegal was another one. And so there are a number of these countries that really are trying to go through the legislation, identifying the adjustments that are needed. Ultimately, it's not to give an advantage to Islamic financings, but it's in order to neutralize some of the impediment that creates an additional cost or additional tax friction when an Islamic financing structure is implemented.
Sure. Afzal, Sukuk is one of the Islamic structures, but it has not been predominantly used in financing, PPP projects. Where do you think these sukuk structures are amenable? What are the drawbacks or what are the challenges from your point of view?
Well, I think the challenges to using sukuk as a financing instrument are the same that would be on a conventional financing, in that it's a one-time drawdown versus a requirement in a greenfield project for drawdowns over several years. So you probably have a negative carry there, and that makes it uneconomically viable for most sponsors. However, we are cautiously optimistic because we're starting to see sponsors thinking about perhaps sukuks as a viable financing mode on takeout financings. We have a whole host of mini perm structures that are coming up for maturity or refinancing in the next 3, 4, 5 years. And I think this will be an exciting time in Islamic finance where we could potentially see sukuks on brownfield and operating assets that have been de-risked and have annuity type income streams that will now be, more acclimatized to a sukuk structure. So we're quite excited about that movement. I think what sukuk does bring to the market also is a new pool of liquidity that was outside of PPP, Islamic PPP in the past. There would be potentially, pension funds or multi managers that have not had access to project finance as an asset class. I think an additional advantage would be, provided these are rated, we potentially could see post-construction yield curves for the first time on project financing, and that will be an invaluable tool for bankers like myself when pricing, refinancings in the region.
Okay, absolutely. No, because you said negative carry. That's a very important aspect. Which on the economics of the transaction. Nobody will incur profit payments when it is not required. Before I move to the question, may I request the participants to put in your questions in the Q&A box instead of in the chat? Thank you. Mohammed, the next question which I would like to ask you is, what role does government play to facilitate Islamic finance in a PPP project? You touched a little bit. Can you go a bit deeper into it?
Sure. Well, ultimately, we mentioned the tax friction, VAT impact, sometimes even the ability to enter into Islamic finance. So we probably will start with the basic, which is that in a number of jurisdictions, Sharia compliant financing is just not possible or wasn't recognized as a legitimate source or technique of financing. So making sure that from a regulatory perspective, it is admitted that if you have the need to be licensed as a lender in the jurisdiction, that licenses are possible, and that the framework is conducive for that. Then we've spoken about the regulatory impact. The central banks are going to be key in terms of the guidance they give to banks in order to allow them to treat in an equivalent way their exposure under a Sharia compliant financing and a conventional financing for these to be acceptable. Now, moving to the awarding authorities, I think it's I would say twofold. I think one is if you are an authority which is looking to tender an asset and wanting to make sure you have access to the largest pool of financing, it is the ability to have assets which are eligible, that are clean from that perspective, that from either an environmental liability or otherwise wouldn't scare kind of lenders off, given the closer proximity to the asset in these structures, and then really it's the making sure that termination clauses are structured under the concession agreement, are treating at par in an equivalent way your conventional lenders and your Islamic or Sharia compliant lenders. You want to make sure that that is a possibility there for your sponsors that are looking to structure their project to be able to tap those two sources of financing in a equally, as opposed to having issues. Is my Sharia compliant financing going to be captured more as an equity financing, or is it going to be more seen as a debt financing portion? As you know, a lot of the projects in the region and PPP in the region provide for a differentiated termination payment structure upon termination that is triggered by the awarding authority, or for and you want to make sure that the debt is kept whole in the same way, irrespective of the nature of the financing. And in our experience, it's required some clarification in the termination clauses and in the termination schedules of some of the concession agreements, to ensure that the debt, whatever the nature of it is, whether it's Sharia compliance financing or conventional, is captured adequately.
Okay, thank you, Mohammed. I think we'll be running out of time. I will go for a couple of questions. Afzal, what has been the growth trajectory of Islamic finance in infrastructure projects over the past decades, particularly in the GCC MENA region?
Yeah,
And
I
where do
mean,
you think the potential is there?
yeah, I think that Islamic finance has witnessed a huge growth over the past, I'd say, 2 decades. The current size is estimated at $4.5 trillion, and a large portion of that asset base sits in the GCC and wider MENA region. I think, as we had already touched on a number of the questions, very few large project financings in the region do not have an Islamic tranche. It's already been recognized as an important liquidity pool by sponsors. I think going forward, what I'm most excited about is how this is replicated in other parts of the world. When you look at OIC countries, which will be a natural demand for Islamic finance, these are some of the fastest growing economies in the world, with large population growth rates, positive economic outlooks. And I think there's a huge opportunity to replicate what's been done in this region in countries like Bangladesh, like Pakistan, like Indonesia, like Malaysia, and also into Central Asia. I think also Africa has an important role in terms of Islamic finance. Again, huge growth engines in Central Africa, Western Africa, that will look to Islamic finance as a viable liquidity pool to finance infrastructure projects.
Yeah, I think the growth centers in future is going to be in Central Asia, where so many projects are coming up in Uzbekistan, Kazakhstan, and also in the African region. There is a recognition of the need for Islamic finance, with the Islamic Development Bank taking a keen role in pushing the Islamic financing. I think these are the two growth centers moving forward. Mohammed, any closing remarks you would like to give before we move to the Q&A session?
Sure. The one point I'd like to make more from a lawyer's perspective is that ultimately, we as PPP practitioners spend a lot of time about structuring documentation at the project level, construction documentation, financing documentation, to make sure that the risks are allocated properly. And I think the Islamic financing angle of it is similar. The one thing I would say, and maybe for the audience which is less familiar with Islamic financing, ultimately you also want to make sure that you have enforceable documentation under the underlying legal system. No Islamic financing structure is going to be in a void without a governing law. So this is where us as lawyers get involved, because your project is going to be located in a specific jurisdiction. Your financing documentation can be governed by a specific law in the relevant project jurisdiction, and you want to make sure that the structure, the contractual relationship under the financing documentation actually work under the governing law when these are, should they be brought before a judge for enforcement or an arbitral panel. So really, it's really to try to demystify some of the concerns, that ultimately no one needs to be a Sharia scholar but you need to understand the contract and need to be able to have a contract which is enforceable under the governing laws which are applicable. And that's ultimately why and how opinions can be given on documentations, because they are implemented as financing transactions under a specific legal system. So just for that clarification.
Okay, that's a good closing remark, Mohammed. Afzal, you wanted to say something?
I think, Hidayah, I mean, having been in the industry now for 2 decades, I think we finally starting to see Islamic finance maturing alongside our conventional peers. I think that sponsors not only look at Islamic finance now as a viable, liquidity pocket, but they also see us as partners on many of these project financings. The one thing I'd like to emphasize is that it goes far beyond just the liquidity. On most of the projects, you see Islamic banks, participants who hold to maturity, and we actually become partners with sponsors on the project. I've never seen a project financing that's gone from signing of EPC to PCOD in a straight line. And I think sponsors have more and more, started to appreciate the value add that we bring to the process, and the fact that we are long-term capital allocators. Very rarely would you see an Islamic bank underwrite and sell down in the secondary market. And I think those are soft touch points that often go unnoticed. But I think it's a very important positive that Islamic banks bring to the market.
Okay, great. Okay, now we will move to, thank you, Afzal, for your concluding remarks. Now we will move to the Q&A session. The first question is from Dr. Kishore. He asks, what is the comparable cost of Islamic finance if we were to compare it with other financiers? Afzal, can you take this?
Yeah, I think on the senior debt level, we probably price in line with our conventional peers. I mean, if you're looking at something more exotic, like a mezzanine debt structure, or something that's more junior on the capital structure, obviously we would, price that appropriately. Again, it comes back to risk and reward matrix. But I think if we're just talking about senior debt, we price in line with many of our conventional peers, and that's why pre-RFPs, you'd find Islamic banks also supporting bids, and that talks to our ability to price appropriately.
Yeah, there is no pricing, differential between conventional and Islamic finance. They are priced same in terms of senior debt. But in other types of financing, there might be differential depending on the risk and reward. The other question is from Mustafa. He asks, do you think Islamic finance in PPPs is suitable for all public services? What are your thoughts on its application to water distribution? Mohammed, can you take this?
Sure. Let me take a stab at this. I mean,
Yeah.
I can't see an in principle issue with one specific type of public service. As I said, I think it ultimately financing social goods, social infrastructure which is shared and which needs a kind of a long-term financing is in principle suitable for this type of financing. So I really don't see an in principle impediment, whether it's for water distribution, wastewater treatment, plants. I'm actually currently working on a number of water distribution schemes in Saudi Arabia, where we are talking to conventional banks as well as Islamic financiers, given the large capex expected. So really, no particular issue. I think as long as the underlying good is is one which is eligible under the Sharia test, which would be in terms of the object, but I think we would struggle to find a public service that doesn't fit that.
Yeah, most of the infrastructure projects are very much amenable to Islamic finance. The other question from Mustafa is how long it takes to complete an Islamic finance transaction in a PPP. Mohammed, can you take this one as well?
So again, here it kind of depends whether you are able to build on a tried and tested approach, but assuming that the variations are limited. And to be honest, in my practice, over the last 20 years, we as is the case with conventional financings, these are really marginal adjustments, structural adjustments. I don't think one can say that structuring an Islamic financing transaction is different from that. That would be the case for conventional financing. So ultimately, where time is required, or where a lot of energy will be spent, is on the actual project documents negotiation, concession negotiation, construction arrangements and procurement aspects, the operation and maintenance aspect, and making sure these are tightly structured. But this would be the case whether you are in a transaction which is financed in accordance with Sharia compliance financing structure or a conventional one. So really, I don't see a difference. As to giving a number of months, I think that would be tricky. It depends on the overall time pressures. Often lawyers and advisors end up working to the speed that is imposed by either the off-taker or the sponsors. And some transactions get done in 6 months, and some transactions get done in 18 months. So really, it depends on a number of levers which are not specific to the type of financing. It's really when the project structuring and risk allocation and risk mitigation has been properly done, due diligence has been properly done, and the credit approval can be processed, in my view.
Yeah, there is one layer which we have for Islamic banks is the Sharia approval. Of course, we work parallelly along with the credit approval process. So it doesn't take much time, or it doesn't add additional time in closing the transaction.
And it's generally well anticipated. You build that into the timeline. You involve your Sharia scholars or Sharia coordination unit early on. You get their sign off on the structure early on, and that is a process which is iterative to ensure that there is no issues in the last minute.
Yeah. There's a question from Hassan Abdul Rahim. Please give some examples of PPP projects with the Islamic finance. If I have to start naming them, it will be a long list.
Maybe you could give examples of the few ones that do not have Islamic finance.
Yeah. In Saudi Arabia itself, you will have at least 50, 60 projects till date. Similarly in UAE, Qatar, Oman, and Bahrain. Since I think the first IWPP project in Saudi Arabia in 2004, all of the PPP projects which have come to the market have Islamic facilities, and the list is growing. The NCP list of projects, pipeline of projects which will come to the market will be mostly Islamically financed. So there's no dearth of
Islamic
finance projects in the market.
Yeah, I mean, maybe just to give some color for Hassan, I mean, I'll just talk about 2 transactions I recently worked on. So years ago, we worked on the Medina airport refinancing. So that was an entirely Islamic Sharia compliant financing, as Afzal has referred to. That was kind of the refinancing at the end of 21, early 22. I mean, more recently in Bahrain, we worked on the Al Dur power and water project refi. That was involving both a conventional tranche as well as a Sharia compliant tranche. And you know, in Saudi, Al Ansar Hospital also had kind of an Islamic financing structure there. So really, I think we would really struggle for large projects which require a combination and deep access to sources of financing. Not to have an Islamic financing is quite a rarity.
Yeah, absolutely. You know, currently in the market, you know, we are closing a couple of, you know, IWPP, IPP, and IWSR projects, as well as, you know, the projects with NEOM and, you know, Red Sea Global. So the market, you know, full of projects which are, you know, Islamically financed. There is one question from NEA Obgebor. Can Islamic finance be used in a blended financing arrangement in PPP projects? Also, do you think Islamic finance is more suited to specific jurisdictions? Afzal, can you take the first part of it?
Yeah, before we get there, I think when you're talking about the number of projects, perhaps the audience would know that many of the projects Hidayah finance are coming up to maturity. And these are very long-term project financing. So
giving up his age now.
Yeah. Absolutely. You know, some are almost, you know, near the, you know, 20 years, you know, PPA term ending.
Yeah, and I think kudos to you, Hidayah, for an excellent job in promoting Islamic finance and being a mentor to many Islamic finance practitioners in the market. Getting back to your point, Hidayah, I think, you know, as I said previously, there's not a single project I know now, large project, that doesn't have at least an Islamic tranche on it. And there's been several that we've mentioned that have pure Islamic financing attached to that project. You know, I think both conventional banks and sponsors have become far more comfortable with having Islamic banks on the capital structure, to the extent that I was recently involved in a deal where the entire project financing was underwritten by an international bank under an Islamic structure, and they sold down their exposure to us pre-funding. Now, that tells me that, you know, conventional banks, international conventional banks, are comfortable both with documentation under Islamic structure and the ability to sell down into a deep Islamic market. And that's come a long way since, you know, we first got involved in Islamic financing, where, you know, people were a little bit worried about what type of structure will be implemented, whether Sharia boards would approve, whether the liquidity would be available for refinancing. So I think that's a great litmus test when you have a conventional international bank having the ability to underwrite under an Islamic structure and sell down under an Islamic structure.
Yeah, absolutely. Afzal, you know, these are the advantages of, you know, having additional, you know, liquidity pool, you know, which sits alongside the conventional financing. Mohammed, the second part of the question was, do you think Islamic finance is more suited to specific jurisdictions?
I mean, the issue is really much more one of cultural affinity. So I think yes, there is a it's just the fact that transactors and bankers and central bank officials will have more exposure and more initial knowledge of Islamic financing structures in the Middle East or Southeast Asia, Bangladesh or Indonesia or Malaysia, than in other jurisdictions where there will be much less familiarity with it. But So I think it's just more of the fact that the number of Islamic banks, the number of transactors that are based and available there, and the availability of liquidity pools on the doorsteps makes it more available for deployment in these jurisdictions. But other than that, I think going back to one point that Afzal made earlier is really the once the regulatory and tax frictions have been neutralized, and that requires a bit of work to be done by the central bank and making sure that the banks are able to deploy capital on a Sharia compliant basis, which is at par with the cost and the approach on conventional financing. We see that those instruments being able to be used in other jurisdictions day in, day out. Ultimately, the majority of the transaction I worked on see that the documentation, the financing documentation, is governed by English law. So that is not something that is a problem from a jurisdiction perspective. It's just that there's a large number of projects to be done in the region. There is more of a proximity and a visibility of these projects to the financial institutions in the region, that they are focusing much more on some of the projects here, and they just applying a risk-benefit approach, and just maybe, I'm sure that, as you've said earlier, Central Asia, Africa, where higher yield, higher return, higher needs are going to be the next stage where you'll see much more happening. And beyond that, you're seeing Islamic financing transactions also in real estate in the US, or transaction in Europe is just driven by either sponsors or lenders that are really keen to push into these markets and use those instruments.
Yeah, I think even in Europe and other places, there is consideration for introducing Islamic finance. We are, I think, running out of time. We have a last question. How public partners should take into consideration Islamic finance characteristics when preparing PPP tenders? Mohammed, can you take this one as well?
Sure, I'll take. I mean, I did cover some of that in the earlier part of the presentation, but really, it's I would say talking to Islamic financiers and as part of your roadshows, making sure that your projects are visible, that they are on their target markets, making sure that as a jurisdiction, you talk to your central bank in the relevant jurisdiction to ensure that Islamic financing is not at a disadvantage, so that you can make sure that you maximize the sources of financing for your project, and then ultimately is making sure that Islamic finance is specifically referenced as eligible source of financing in the termination provisions of the financing. I mean, rarely would the concession agreement itself have a huge impact on the eligibility or the structure of the financing. Really, it's just making sure that the product is visible, the product is marketed to these sorts of financing, and then that Islamic financing is specifically referenced as a eligible financing at the time of the bid that is submitted by the sponsor to be able to make sure that you can submit your financing either as a conventional or Islamic finance, and that's equally acceptable.
Yeah, just to supplement what you said, what I have seen in Saudi Arabia is NCP, as the nodal agency for PPP, reaches out to Islamic banks, to take their feedback in, structuring these projects, asking us, are there any special considerations, are required. So this is a welcome gesture from NCP. So that's it. To conclude, the convergence of Islamic finance and PPPs holds tremendous potential for addressing the infrastructure needs of our communities in a sustainable and ethical manner. By leveraging these principles of Islamic finance, we can not only mobilize the necessary capital, but will also ensure that our development efforts are aligned with the broader goals of social justice, environmental stewardship, and economic inclusiveness. With this, I bring the session to a close. Thank you, Mohammed. Thank you, Afzal. And thank you, everyone who has attended this webinar. Thank you. We will have a follow-up webinar going deep into structures. So we'll do some case studies in the future. Thank you for now. Take care. Bye-bye.
Thank you.